The causality between taper and asset prices, there's very little evidence, as you point out, although other people would say otherwise. What are they seeing that they shouldn't?
Well, we've done the work with event-based studies, and we've looked at every iteration of QE, and not just in the US, around the world. And look, it must be true that each of the QEs was different, had a different context. In fact, I've even forgotten what half of the contexts were, but QE1 happened at the time of the GFC and the housing crisis. QE3 was more about getting a reflation going, and QE4 happened by accident, by the way, because it wasn't called QE4 when it started in March 2020. They came in to intervene to remove illiquid securities from dealer books. So to presume that the outcomes of the tapering for QE4 would anyhow be the same as any of the previous iterations seems naive. And the data, the facts, tend to prove that. So for me, it's about the valuation. How far is the yield away from the equilibrium? And today the equilibrium is the longer run dot, right? So the forward yields are close to that. And how was it communicated? So in 2013, it was a mess. They made a mess of it, and the valuations were tight.
Yeah, so they conflated the reduction of buying bonds with the next interest rate hike. And that was the difference between then and now. But all of those QEs have one thing in common, and that is making asset bubbles in places perhaps where you don't need them. And that is the issue.
Yeah, it is the issue, and QE has contributed to wealth inequality and asset price bubbles. And all of the financial stability documents, macroprudential work, has been pointing out the need to mitigate this unintended bad consequence. And if you look at what's happening in China, they've studied these documents, they've looked at what's happened in other countries, and they're trying to deal with it. Otherwise, they'll end up with zero rates or negative rates, and they're trying to avoid that. So we should think about things globally, and the context, it's very important. And so you were talking about credit markets in China just now. Well, that is connected to the policy choice that is being made at this point in time.
I mean, you make the distinction. I was wondering if you could talk a little bit more about the inequality issue. Because you're the biggest bond bull out there. I mean, you're still at 1%, really, for this year on the 10-year Treasury. What is that connection?
Well, I haven't really changed any of our views for a long time. It's been a decade of having probably the lowest bond yield on the street. And we haven't moved this year. I still maintain that we're probably going to end up the year nearer to 1 than to 2%, and I don't fully understand why the consensus forecasts are anywhere near 2%. To me, that's not particularly robust mathematically. I mean, there has to be a very hawkish tilt from the Fed very soon for that to be possible, and it's very unlikely. So when we look at the range of plausible outcomes, we think that the balance of risk is towards lower yields. Now, wealth inequality did contribute to lower real rates over time, as did excessive debt, as did aging populations and technology. When you look at the interaction between those determinants, think about how debt and wealth inequality can be combined to continue to force rates down, or to limit how much they might ever go up. The fact is, when you've got a very small percentage of the population, and this is true of China and in the US, that has the vast amount of wealth, then they are not as sensitive to the rate move on the liability side
but the debt,
as the poorer people.
You can't ignore the debt side, though, can you, Steve? Because if you start raising rates, this becomes a massive issue in terms of defaults, and you have a world which is essentially addicted to free money. It's like weaning off a heroin addict from heroin.
So there's theory and practice. If rates were to go up, and I'm going to say if, because I'll believe it when I see it.
Are we stuck with low rates for the next decade?
Well, look at Japan. So 20 plus years. So I think it's unlikely that the Fed is going to hike anytime soon. And in fact, I would even argue that 2023 is too soon. But if they were to hike, are we ready for what's going to happen? What happens to asset prices and the feedback loop, therefore, into policy? So we are a bit stuck in a debt trap. And that's been informing our forecasts for a long time. Well, we're having to learn to live with lower for longer. For lower for longer rates to be wrong, for it to be reversed, for us to change our mind, all of those determinants, those long-term drivers, have to start moving around. Also, what has to happen is that everyone who doesn't believe it has to actually capitulate and start believing it. Once everyone else believes the same thing, it ain't going to happen.
He's talking his own book. He's talking his own book here.
Well, that brings up 2 points. Well, I guess sort of connected. One is, if the equilibrium rate, say, is much, much lower than we think, does 2% inflation target, does that still work does the math still work on that in a world of this? And is the best value still in sovereigns, because you're neutral in sovereigns?
Yeah, so the call on neutrality or bullishness is a monthly thing that we're going to adjust depending on the valuations.
Okay.
Yeah. So the 2.5% longer run dot is the Fed's estimate of equilibrium. That was above 4% in 2013. The trend is down. I would be surprised if it's above 2 in a year's time. It's probably going to have a 1 handle by the time they do hike. So when they do actually hike, if they hike, they're not going to go very far, and they're going to tell us they're not going very far. So imagine if the longer run dot becomes 1.25.
Well, it's 4 or 5 from now.
Well,
steps.
Yeah, but no, but the longer run dot is currently 2.5. That's what they say they will get to if they hike. I'm saying that by the time they hike, they might admit themselves that they're only going to go to 1.25. Yeah. Right? In which case, 1% for 10-year treasuries doesn't seem too wrong.
Just very, very quickly, how does the dollar figure in your thinking? Because, I mean, it would seem from your thesis here that the path of least resistance is to the downside.
Well, yes, if it was only the US fundamentals and US rates that mattered, but clearly there's the other side of the equation. And in Europe, I worry about a hawkish policy move or even a mistake, because here the tapering, how they communicate, is so important, and also what's happening in China it's so important to the dollar call. So look, just based on what I've said about the US, yeah, it's a softer dollar, but there's much more to it.